Reagan Wolfe.
So you're about to sell your business, or you get an offer. Start to get really excited about the number, and then you call your CPA. After talking through the numbers, you start to realize that net after taxes, that you're going to net significantly less. Your excitement quickly starts to diminish. Well, I'm here tonight to tell you about the ultimate tax burden on the sale of your business and ways you can mitigate that tax burden. As mentioned, Reagan Wolfe with Ashford Advisors, and we first meet an entrepreneur or a business owner. We're certainly not the first financial professional that they met. They've typically worked with a slew of financial professionals, bankers, property and casualty experts, group benefits advisors, real estate professionals, mortgage bankers, CPAs, attorneys, investment advisors, insurance professionals. And the assumption by many is that because of all those relationships, they have a well-coordinated and organized financial life. But that assumption is typically wrong. What we tend to see is there's a lot of overlap, duplications, waste, voids, blind spots, inefficiencies, more of a junk drawer approach to planning. Our role in working with the clients is to come alongside them to help them manage all the moving parts and all the relationships in their financial life to maximize organization, coordination, and efficiency. When this happens, we put them in a position of financial security and confidence they would have not had if we had not met, and also frees them up to be the best version of themselves as a father, a mother, a husband, wife, entrepreneur, or business owner. Tonight we're going to talk about one of the looming blind spots on a client's balance sheet, and that is the ultimate sale and the tax burden for the ultimate sale of their business. These three ideas we'll cover are trust planning, gifting of the business pre-sale, and tax loss harvesting. Trust planning. Now, many, when they think of trust planning, they think about moving assets into a vehicle, locking that vehicle up, and throwing away the key. They think of losing access and control. They think of only benefiting those assets only benefiting somebody else from then on, not themselves. Well, that's certainly possible. That's a way you could set it up, and many attorneys might recommend that, but it's certainly not the only way, and we would argue it's not the best way for entrepreneurs and business owners that are growing and building wealth. A couple different tax benefits. One is upon the sale, and we won't spend much time on this tonight, but it is possible under many circumstances to mitigate or potentially eliminate state income taxes. So in the state of Georgia, 6% on the sale of a business could be a lot of money. We'll spend most of our time upon death. Let's dig in. So let's first remind ourselves that the first $27 million per couple, or $13.61 million per person, is exempted from estate taxes. So anything above and beyond that is when the estate tax starts to kick in. Next year, indexed for inflation, it'll be roughly $28 million per couple, or $14 million per person. In 2026, we don't quite know what it's going to be. It's set currently to reset to the Pre-Tax Cuts and Jobs Act of 2017, which is about $7 million per person. Now, the current administration, the Trump administration actually implemented the Tax Cuts and Jobs Act, and now with a new administration coming in next year, there's an assumption that it might continue to be $13 to $14 million per person, but it is unknown. Let's go through an example. So a married couple, if they were to die in 2024 with a $50 million estate, the first $27.2 million is exempted from estate tax. 22.8 is subject to estate taxes, which at the highest top federal estate tax rate, 40%, puts you a little over $9 million owed. 2025, slightly less because of the index for inflation, but about $9 million is owed in taxes. That's owed in cash within 9 months. With proper trust planning, the same $50 million, if we can shift the assets outside the estate below the exemption level and then let them grow, if that happened in this example, even with the ultimate value being $50 million, all those assets outside the estate would be zero taxes. So for those of you that aspire to create a lot of value and ultimately sell for a large amount, this could be a significant amount of wealth created, preserved. I don't know if anybody's familiar with the Joe Robbie story. Joe Robbie died in 1990, and he owned the Miami Dolphins and the Joe Robbie Stadium. His heirs quickly learned after his death that they owed $47 million in taxes. They had nowhere to go to get that money. Ultimately, they were forced to sell the stadium and the team, no longer owned by the family, just to pay for the estate taxes. All right. Any Yellowstone fans in here? Spoiler alert, John Dutton died. Big estate tax problem. That's what they're dealing with. Other benefits to proper trust planning: creditor protection, also what we call predator protection. Anybody trying to come after your assets, also maintaining access and control of those assets, and ultimately for generations to come. One client example is we moved a business worth about $5 million out of the estate into a trust. 2 years later, the client sold for $66 million. All that estate tax-free, creditor protected, predator protected, and also protected for generations to come. Let's jump to strategy number 2. And this is more for charitably inclined people, but gifting of a portion of your business pre-sale. Let's first talk about what it means just to give donation to a 501c3 charity just out of your annual income. Let's say someone has $1 million of income. Left side is no deduction. So no charitable donation. So at the highest federal tax rate, all the $1 million is taxed, federal and state. Somewhere in the neighborhood of $430,000 is owed. On the right, this person gives $100,000 to a charity for a net taxable income of $900,000. So you get a tax deduction, reduces your taxable income, and then ultimately, after federal and state taxes, $387,000 is owed. So $43,000 is saved in this example. So about 60 cents on the dollar is effectively what the person is paying for that. Some of you may be familiar with a donor advised fund. So as opposed to giving directly to a charity, you can give to a donor advised fund. Think of it as your own personal 501c3. You give in 1 year, and you get a full tax deduction in that year. But you don't have to determine who actually gets the money quite yet. You can invest it, and then ultimately distribute it when the time's right to who you'd like. So many times business owners who are charitable will want to sell, and in a big tax year when they sell, will ultimately want to give a lot of the money, and they can even advance their future giving. So if they're giving $100,000 a year over the next 10 years, they may advance it in 1 year. So let's look at the left side. This is post-sale. So this is selling the business, taking the cash from the sale of the business, and then putting it into a donor advised fund or giving it to a charity. But the portion of the business, ultimately where that $1 million came from, had a cost basis of $100,000. So there's a $900,000 gain. Well, the income tax saved is $430,000, just like the last slide, 43%. But they ultimately paid long-term capital gains tax on the $900,000, federal, state, and potentially net investment income tax as well. So all that got paid. So in this transaction, we have to add that back in, and they effectively paid $838,000. That's the after-tax cost of the gift. Well, if you shifted a portion of the business pre-sale to a donor advised fund, and then allow that donor advised fund to sell that portion of the business in the end, and the transaction at the closing table, now they get the cash. So the same is true on the top half on the pre-sale, except for we're able to avoid that long-term capital gains tax. So effectively 30 cents on the dollar, as opposed to 60 cents on the dollar, $268,000 of additional money saved. Same $1 million, same loss, right? Still giving away, but it cost you 30 cents on the dollar, and the charities that are important to you got a lot more money simply off shifting it pre-sale. All right, third and final, tax loss harvesting. So tax loss harvesting is referring to when you have marketable securities, so stock market based, outside of a retirement plan, stocks, bonds, mutual funds, things of that sort. And we're trying to take advantage of the volatility of the market, that when losses occur, but key point is we're not trying to take losses and just end up with losses. We're ultimately trying to get market returns. So let's take an example. Let's say you have a $500,000 portfolio, and I'm just going to look at one little sleeve, one stock. We'll say it's Home Depot, $5,000 of Home Depot stock. It goes down by 10%. Well, the market value then is $4,500. Well, you can sell that, harvest those losses, and now you have $4,500. You can reinvest those proceeds and wait for the market to recover. So let's say you own 5,000 Home Depot stock. You decide when you sell to reinvest in an ETF or in Lowe's, another large cap U.S. stock, consumer discretionary, home building business, and then the market recovers. So you started off with 5,000, you ended up with 5,000, but ultimately you now have a paper loss of $500 on your balance sheet to offset future capital gains. Now, a few things to note, because that's one little sliver of a portfolio. This is a very active and time-intensive approach. You need computers, algorithms, people. It's very hard to do individually. Losses can be carried forward indefinitely. And then you also have rules to abide by, like a 30-day wash sale rules. You can't turn around and buy Home Depot but right after. You can't have owned it 30 days before. You actually have to own something else. So in that example, Lowe's, you may own Lowe's for 30 days and 31st day buy Home Depot back, right? But a couple examples, a client who's a business owner sold their business, invested $10 million in the market, and then about 3 years ago, been able to harvest $3.5 million worth of losses to offset future capital gain, and meanwhile getting the Russell 3000 returns, so got the returns of the market. Another one, business owner has about $2.5 million they've saved just through distributions the last few years, and they've harvested about $500,000 of losses. So this can be a decades-long approach to investing that can ultimately help you offset the future capital gains. In conclusion, proactive and efficient tax planning can mitigate the long-term impact of the long-term capital gains on your business, leading you to preserving more wealth and ultimately to a nice exit. If you'd like to download the slides that we used tonight, scan that QR code, and all those will be directly available via PDF. Thank you so much.